Hello wizards, and welcome to the Academy, where you will learn about how to read liquidity flows in the global economy and macroeconomics. Today, we're going to introduce you to the US Liquidity Oscillator. This is an indicator that is derived from the net US liquidity model and measures the deviation of the S&P price from the underlying liquidity conditions in the US markets. For context, please refer to our previous video if you missed a discussion on net liquidity. So, the delta reported in this KPI up here represents the difference between the market value of the S&P 500 and US liquidity. When the delta is positive, this orange oscillator moves upward, suggesting that the S&P may be overpriced. Vice versa, if the price swings below the liquidity threshold, the oscillator swings below zero, and the S&P can be considered oversold. At the time of shooting this video, looking at the past performance of this indicator, we can see how the S&P price delta has been predominantly compressed within a range from minus 300 to plus 500 points away from its point of equilibrium. The correlation with the S&P since the COVID crash has been significant, but always keep in mind that price momentum and liquidity conditions can diverge in the short term for a variety of reasons. While the liquidity injected through QE into the banking sector's reserves transfers via the revaluation of assets and the dropping of interest rates to the liabilities side of their balance sheet, becoming public money, this doesn't necessarily express the willingness of every new dollar in circulation to bid up US equities and risk assets in general. But the correlation is there because practically this behavior cannot be totally discounted, and the revaluation of cash flow leads to the revaluation of assets across all financial markets due to the opportunity cost of holding value in a checking account that doesn't yield any return. Going back to the chart though, let's note how, in both cases at the end of 2021 and at the end of 2022, we had these two big outliers with big liquidity drops into the repo and back out the next day. Actually, if we scroll down to the data frame and search for the last one of these events, you will actually see one of these liquidity drops here in the net liquidity column. If we quickly go back to the net liquidity chart, you will notice the same events. Also, in this chart's data frame, we can further decompose the data into its constituents. Notice how almost $250 billion get into the repo. And if we type in the date of the first day of the new year, which on Monday was the 2nd of January, you can see exactly how the money immediately flew out of the repo and back into the markets. So, these events have ultimately been labeled as window dressing and can be reasonably expected at the end of each new year. And it's best to keep that in mind. In conclusion, while the integration of these informations into your trading setups or investment strategies is entirely discretionary, and we strongly advise against excessive speculation, we believe that this indicator can provide valuable context and complement other converging signals. After all, the liquidity conditions and the state of the US financial markets are undoubtedly the most critical in the world. Thank you for watching, Wizard. Please consider subscribing and turning on the bell icon if you don't want to miss our next release, where we will talk more about the US reserve balances and how to use that liquidity data to get the most important insights to benefit your long-term investment strategy.